Welcome to The Explainer. Today, we're strapping in to examine the data science behind a massive, and I mean almost unprecedented, volatility shockwave. We're looking at the options market mechanics surrounding the June 4th, 2024 elections. So if you've ever wondered what an actual financial black swan looks like under a microscope, well, you're in exactly the right place.
Now, before we jump into the charts, let's just lay down some ground rules. This explainer is an objective, historical data analysis of derivatives behavior and market risk mechanics. We're strictly focused on the quantitative data and the structural options mechanics here. We are not looking at this through a political lens, and we are absolutely not taking any sides regarding the looks about election results. Our focus is entirely on how the math broke down and exactly what the numbers tell us about liquidity.
Here's our Q&A roadmap for today. 1. Decoding IV in Vega. 2. May 31st, the benchmark regime. 3. June 3rd, exit pole pump. 4. June 4th, the shock wave. And 5. The nonlinear Vega trap. Let's get right into it.
To frame our whole investigation today, let's treat this kind of like a Q&A with a derivatives risk manager who actually survived the event. The first overarching question we really have to ask is, how do options markets actually behave when standard risk parameters completely shatter? I mean, what happens when the mathematical models everyone relies on just stop working? Keep that question in the back of your mind as we break down the mechanics.
Okay, let's dive into this. Section 1. Decoding IV and Vega.
So, our horizontal playing field is the x-axis, implied volatility, or IV. As you probably know, as IV expands out to the right, options premiums grow significantly more expensive. Basically, this is the cost of insurance just blowing out.
And our vertical playing field is the y-axis, which measures Vega change. Moving up into positive territory, like +2 to +6, means accelerating long volatility exposure. Dropping down into negative territory, well, that signifies massive short volatility exposure, or severe structural Vega decay. So just remember, up is expansion, down is structural decay.
To make sense of all this chaos, we're going to use a strict chronological color code. Light blue represents May 31st, 2024, orange represents June 3rd, and green represents the ultimate shockwave on June 4th. Whenever you see these colors, just anchor yourself to the timeline, okay? Blue's the setup, orange is the catalyst, and green is the explosion.
Section 2. May 31st, the benchmark regime.
I want you to picture the trading desks on a quiet Friday afternoon. Notice how this light blue cluster for May 31st is tightly compressed horizontally between 30 to 43% IV and bounded perfectly vertically between -2 and 0 Vega. This is a highly stable, completely normalized regime. It's just predictable, structured pricing as traders were quietly coasting into the weekend. But, well, so much for a relaxing weekend, right? The next question we have to ask our data is this. What happens to a perfectly structured market when an entirely unexpected political poll hits the wire on a Sunday?
Moving to Section 3. June 3, exit pole pump.
Now, what's really interesting about this is that when the market gapped up Monday morning, the orange cluster literally split into two completely separate mechanical wings. The upper wing saw a massive spike in sensitivity, which accelerated the exposure for long premium buyers. But contrast that with the lower wing, plunging all the way down to -8 Vega. Deep out-of-the-money shorts were rapidly forced into the money, totally stripping them of pricing power. The market was tearing in two completely opposite directions.
Which brings us to Section 4. June 4, the shock wave.
If our previous question was about unexpected news, the question for June 4th is a whole lot darker. How does absolute structural panic look on a data science grid? Like, when raw human emotion and margin calls completely take over the algorithms, what visual shape does that actually make?
Well, it looks like absolute chaos. In what we call the chaotic vortex center, right between 45 to 70% IV, Vega change scatters violently from +6 all the way down to -6. This is wild intra-hour short covering and forced margin liquidations happening in real time. But then, look at the hyper IV compression curve. As IV stretches to astronomical levels, we're talking 70 to 100%, Vega sensitivity actually tapers off. Premium pricing is no longer about incremental volatility at that point. It's driven almost purely by intrinsic delta and just raw panic.
Section 5. The nonlinear Vega trap.
So, the absolutely crucial point we need to focus on is this exact number, 49.34.
Now, this isn't just some random calculation. This specific implied volatility anchor point is exactly where standard risk positioning officially gave way to systemic crisis.
Let's break down why this is the gateway to systemic crisis. On June 4th, at exactly 49.34 IV, the Vega change was 0.58. It was hovering right near neutral. But the very moment the market pushed past that roughly 50% IV threshold, the data completely fractured. Everything swept aggressively downward and outward into that vortex and compression curve we were just looking at. This single data point represents the exact threshold where risk management totally failed and the mathematical models just inverted.
And that leads us to the core structural rule derived from this entire Q&A analysis. Let me just quote it. When a black swan event expands IV past roughly 60%, Vega risk behaves non-linearly, flattening out at extreme premium levels and permanently trapping short volatility sellers who cannot find liquid counterparties to hedge. At that point, you stop playing a game of manageable risk and you start playing a game of pure survival where the math is actively working against you.
We've seen the blue benchmark calm, the orange exit pole bifurcation, and the absolute green chaos of the shockwave. The data is incredibly clear here. Beyond a certain threshold, the market stops behaving rationally, and it traps anyone caught on the wrong side of volatility. So, I leave you with this thought to reflect on for your own risk parameters. When the next black swan traps the market, will your hedges actually hold up, or will you be caught in the vortex? Thanks for joining me on this deep dive. Keep asking questions, keep looking at the data, and we'll see you in the next explainer.